Is it now time for you to buy stocks with market near all-time highs? So in today's video, we'll be talking about buying stocks at all-time highs, apparel stocks that are crashing, as well as some questions left in the comment section below. So let's talk about buying at all-time highs first, and this is what Tom Lee actually said about the market conditions today.
Want to name some?
And then there is signs of speculation. But the one thing that was true in 2021 that's not true now is when I meet with fund managers, in 2021 they said there was no stock they could buy because everything was expensive. That's actually not true anymore. Now the people I talk to are saying, look, the numbers have been better and numbers are going up, but the macro is making them uncertain. So there's actually a lot less risk taking by institutional investors.
But what is the underlying view that you have that makes you bullish? Is it that the economy's hanging in? Is it that earnings are picking up?
Well,
what's the fundamental reason?
I think when we look at macro, on the margin, things are better. We have better visibility on tariffs into 2026. We have regulation and tax, like legislation visibility into 2026. I think the Fed is now being questioned about their unwillingness to cut. I mean, it was apparent like 5 out of the 10 questions during the press conference were about that exact question. So there's a dovish Fed. I know consumers are overly cautious right now, but as you know, inflation expectations are far above CPI. That's a positive surprise if delivered inflation's lower. And then businesses have been really resilient. You know, I mean, I think actually the economy might be weakening, but earnings have been better. So overall, with all the cash on the sidelines, I mean, I would say we should be quite bullish actually.
So Tom Lee is bullish again, and as you can see from here as well, buying at all-time highs has actually given out better returns as compared to investing on any single day. So there's a saying that goes that you shouldn't be timing the market. Instead, what you should be doing is to simply just buy at any price, buy at every single price so that you can capture the maximum upside at any point of time. So there's an argument to be made about buying at all-time highs. But this is the market valuations today. If you have to consider the market forward P over the next 12 months, the markets are actually trading at a 21.6 times earnings as compared to its historical average of around 19.9 times over the past 5 years and around 18.5 times over the past 10 years. So clearly this market is a pricey one. It is comparable to around 2021 period when the market traded up to around a 23 times forward earnings. So Warren Buffett's cash pile has also been growing over the past years, and currently now Warren Buffett's cash as a percentage of the total Berkshire assets is actually at all-time highs. And Warren Buffett has been quite good at timing the markets as well. So before the dot-com bubble, he actually raised cash. And then as soon as the dot-com bubble came, he deployed a lot of that cash. Same thing for the period between 2003 to 2008. Warren Buffett was crazily raising cash. And then as soon as the crisis hit, he deployed a lot of the cash over here. So he's doing something similar in the current market today. He's raising a lot of cash. And that could be a sign that the markets are overvalued today. So there's another metric to look out for as well, which is your bond yield minus your earnings yield. So typically when you want to buy stocks when the earnings yield is greater than the bond yield itself, because for your bonds, they are almost risk-free. But for your companies and your stocks, they must have a higher yield because you have to take on some form of risk when it comes to owning the stock itself. But currently, the bond yield is actually higher than your earnings yield itself. Your earnings yield is around 3.4% as compared to your bond yield, which is at around 4% or so. So what this means is that you can potentially get a better return if you're to just invest in bonds itself, just based off the earnings yield or the S&P 500. Meaning to say the zero risk bond is actually offering more returns as compared to the risky S&P 500. So in summary, markets are overvalued. Buying at all-time highs in the long term will pay off for sure. So over the next 20 years, if you're to buy at all-time highs, you shouldn't have any problem with it as long as you hold it for the very long term. But there are opportunities outside of the US now which are quite compelling. And I think overall for the US market, it's quite overvalued. And that's why you're seeing Warren Buffett raising a lot of cash. So I think in the near term, there are better opportunities outside of the US. In China as well, with companies like Moutai and Alibaba, which are trading at quite decent valuations and are quite high quality in terms of the business fundamentals as well. Next portion that I'll be talking about is your apparel stocks crashing. So Nike, for example, has dropped around 17% year to date. It's currently trading at a 20 times earnings at a 2% dividend yield. So for Nike stock, they have surprisingly decent metrics in terms of your ROIC. So ROIC of around 11%, ROC of around 18%, ROE of 31%. It is quite decent for a company like Nike. And for Nike, it is currently experiencing suppressed margins as well as suppressed earnings. So for Nike, the problem is this: the business is not vertically integrated, which means that they outsource their products to all your different factories in other countries like Vietnam, in China, and so on. And the problem with that is when your tariff event starts to come, that could significantly increase the cost of goods for Nike itself. and that's why you're seeing the margins getting hurt over time. So for Nike, this is their market share over time as well. And as you can see, the market share has been declining over the past few years. So Nike's market share has actually dropped from around 39% to around 32%, and other companies are actually taking share away from Nike. So for Nike, they're shifting to online as well. This is what Elliot Hill, their new CEO, is doing. They're trying to shift more of their sales to online, and I'm supportive of this change because it will help to jerk up their margins over time, and it will reduce the human capital cost for Nike itself, which is one of the significant portions of the business cost. So for Nike, outside of the fact that the company has competition and innovation risk, the brand name of the company is great, so I expect Nike to be around in the next 10 years, 20 years or so. And so with their new CEO, Elliot Hill, I think this could be an inflection point for Nike from here on out. So if you're thinking of investing into Nike today, I don't think it is a bad choice, but for me, I'm staying out of this one. Next stock is Lululemon. So Lululemon year to date is down around 40%. It is currently trading at a 15 times earnings. So for Lululemon, the metrics are quite remarkable as well. It is even better than Nike. So they have profit margins of around 16%, which is quite high for an apparel company. They have ROE of 42%, ROIC of 27%. All these metrics are incredible for any given company. So for Lululemon, the valuation itself is at its historical low as well. So over the past 10 years, the company has never traded below 20 times earnings and is currently trading at a 15 times earnings. And if you were to look into their latest report as well, this is their latest report, the China revenue actually grew around 21%, and the rest of the world net revenue also grew by around 16%. So for Lululemon, I think the growth story in the US is gone, but their international sales portion is drastically growing. If you are a consumer of their products and you want to bet on a mean reversion for this company, it's not a bad company to buy into now, especially given the low valuation. But for me, it's an avoid simply because of the risk associated with the company. So I don't think the company has a very strong name. It's not a legacy brand like your Hermes, your LVMH and so on, nor does it have the brand power of Nike. I think the upside here for this company is drastically greater as compared to the downside. But for me, it's just one that is too risky. So in your apparel and your footwear industry, I think a better company to look at is Antasport. So Antasport is actually based in China. Currently year to date is around 22%. It's trading at a 15 times earnings, giving you a dividend yield of around 2.53%. So for Antasport, this is their metrics. So they have incredibly high profit margins. If you thought Lululemon 16% profit margins are high, Antasport's margins are actually a lot higher. It's around 22%. So why is Anta able to increase their profit margins at such a high rate and have such high margins as well? It's because the company is vertically integrated. They have their own factories in China and they don't have to outsource it. So for Antasport, even in 2020, even during the COVID year, they still managed to grow revenue, and the company has been quite resilient over the past few years. The company that is growing revenue at 13 to 14%, and the Chinese are increasingly supportive of their Chinese brands compared to the international brands itself. So for Antasport, I think this one is a quality company. If you're interested in this one, you can look into it. Fundamentals are great, and the brand name in China is quite great as well. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says thoughts on Symbotic. So Symbotic is actually a company that does your robot. What they do is they create robots and then they sell it to all your different companies. But for Symbotic, the problem in the business itself is the company is not profitable yet. And for me, companies like this are speculative in nature. If the company doesn't have a history of growing earnings, growing revenue, then for me, it's a simple avoid. I think for Symbotic, it's a speculative company that retail is chasing today. Next one, it says, I actually exited United Health. It's an incredibly low valuation, but the DOJ investigation can absolutely destroy their moat. If they have increasing revenue from arbitrarily denying patients and utilizing AI for denials, the reputation will be absolutely tarnished. With a tarnished reputation and likely government intervention, the company is susceptible to destruction, even with them being one of the largest companies in the US. If anything, I think United Health works as a low allocation speculative play on the upside due to its valuation. So for United Health, the company has a lot of risk for sure, but if you have to look back at all the other healthcare companies that face a similar situation in terms of regulations before, for example, Humana or CVS, they were let off with a fine. So for all these insurance companies, they have a large base underneath them. So for example, United Health is the largest insurance company in the US itself, and the government will be doing more harm than good if they were to stop United Health from being able to provide insurance to all your different consumers in the US. So I don't think that one is very likely in terms of destroying the company. And for insurance companies in general, they have a bad reputation, so I don't think it is a reputational problem for United Health. What I think could be a structural problem is the company basically withdrawing themselves from the Medicare portion. So United Health actually derives a lot of their revenue from Medicare, and they're reducing broker commission. So what they're doing is they're trying to stop the brokers from issuing and promoting United Healthcare's insurance. So for United Health, it is a company that faces a lot of risk, and I agree that it works as a low allocation speculative play on the upside. That's what I'm doing as well. I think United Health is undervalued. It's probably one of the better opportunities in the market today. I hope you guys have found this one useful and invest safe.